What happens to unused long-term care
I was
insurance?
hoping you might ask me that. There's 3 different kinds of long-term care insurance out there. There's what we call traditional standalone. All it is long-term care insurance. If you don't ever need it, all the money you paid for it, it's gone. It's like homeowners insurance if your house doesn't burn down. You've transferred risk at a price. You know what that price is. That's you're just out of luck if you're looking to get money back out of that. The second kind of insurance is what they call asset-based care, which is a life insurance chassis with a separate bucket that has nothing in it but money used for long-term care. So you can't tap that money. It doesn't really exist unless you go on claim. But if you never go on claim and you die, the life insurance benefits paid out to your family tax-free. So you have a win-win kind of a situation there. It's more expensive than the traditional because you're getting underwritten for 2 different things. The final kind is what we call a hybrid. It's usually on a universal life insurance chassis with what they call an accelerated benefit rider. So you might get a 1% or 2% or 4% rider that kicks in if your doctors tell you you need help with at least 2 activities of daily living. So if you meet those requirements, then that death benefit can be used while you're alive to pay for your care. Typically, if you might run out if you don't have very much life insurance in that policy. You could, for instance, you have $100,000 and you have a 2% rider. That's 50 months of $2,000 a month. So that's what you would get. When it runs out, most of the insurance companies, though, keep a residual of 10% in the bucket for final expense. So when you do die, there's at least a little bit of money there to help the family take care of those funeral costs and things like that. But the choice, whether you pick a traditional plan or an asset-based care plan or a hybrid plan, is going to be in part due to how much money you have lying around, because those asset-based care plans are typically single premium. You might have an annuity or a life insurance policy you no longer need, and you can do what they call a 1035 exchange, which is a tax code paragraph that allows you to move money from one vehicle to another without incurring any tax and use that money to fund the policy. The standalone is usually a pay-as-you-go type of proposition. Most people buy and pay either monthly or quarterly. I've never yet seen anybody pay it annually. And then the hybrid plan is life insurance. You're paying a premium for the life insurance, and that rider is attached to that life insurance at a cost.
Nice.
That's the least effective way of doing it because there's no inflation that can be. It's not going to grow. And so if you have a $200,000 life insurance policy that's going to pay out $4,000 a month, and you're 60, and you need the care 25 years from now, it's still $4,000 a month. And the cost of care, extended care, is not going to stagnate. I mean, it's not going to go down. It's going to go up. And so there's that to consider. When do you need it? That's, if you're 75 and can afford a life insurance policy with a rider, that's not a bad way to go, because you're probably going to need that fairly soon, if at all. And it gives you a death benefit if you don't need it. But if you're 55, that's really not the most effective use of your money. You're better off getting a traditional plan and letting it grow with inflation on there. And one thing that hasn't been mentioned, why you might want to do that, is the partnership program in the state of Michigan, and all over the country for that matter. All 50 states now have a partnership program that lets you buy a policy with a fixed amount of money. So let's say we'll go back to that $144,000 amount. if you exhaust that and want to apply for Medicaid, you can set aside $144,000 of assets and still be able to apply as not having any assets. And eventually when you die, the state can no longer come back with those policies. They can't come back and recapture assets to pay themselves back for the care they gave you. So that's a consideration that, unfortunately, I see not a lot of people taking advantage of. They're more of the, well, if I don't want to lose it, so I don't want to use it or lose it approach. But they just have to be educated enough to know that there's some downside to that approach to getting care.
Perfect. If you want to learn more about long-term care insurance, click on this. This is a playlist where we answer all relevant questions. If that helped, hit the subscribe, and we're going to keep bringing great videos for you. Thanks.